All right, so joining us this morning at Post 9, UBS Senior VP of Wealth Management, Jim Lacamp, and Credit Suisse Chief U.S. Equity Strategist, Managing Director, Jonathan Golub. Guys, happy Friday. It's good to see you both. Jonathan, you've had an interesting journey this year because you were pretty constructive in the first half.
Right.
You started to adjust your model mid-year. Where are you right now, given what rates have been telling us?
So we put out a 30-25 target for the year, which when we did, everybody thought that we were insanely bullish. We hit that, I don't know, maybe about 8 or 10 weeks ago, and everyone's waiting for me to raise it. And I said, I'm not comfortable with conditions. I think that we're looking at flat money, and it's really important. I'm not saying I think the market's going to fall apart. We're not going into recession. Do we eventually get a recession? Sure, but it's not in the near-term horizon. But the underlying data is really concerning, and falling interest rates like this are not a good thing for equities.
Underlying data, what? We just had the biggest jump in retail sales in 4 months, right? I mean, jobless claims, employment continue to be robust. What's wrong?
Well, I think I met with Scott who mentioned this. You really have two markets. You have a consumer that's in surprisingly healthy shape. Unemployment is low. He's super confident. He's getting a raise. And then the cyclical data is real. It's probably whether we're in a global industrial recession or on the cusp of one. In Europe, German data contracting, China data contracting, and this is exactly what we had in 2015, where you had a kind of an okay economy and a kind of recessionary industrial economy at the same time.
Yeah, the trade war, though, is the biggest risk card. And nobody knows how that's going to play out, Jim.
We certainly don't. We have a lot of negative potential catalysts in front of us and not that many potential positive catalysts over the next few months. Remember where we are seasonally. August and September, historically, are our most volatile months. Now we've got a market that has already given everybody what it wanted this year. If you look at where Bank of America, the Goldman Sachs, Credit Suisse, everybody already hit their targets this year, and nobody knew what to do from there because the economy was already starting to slow down and the trade wars were heating up. Now we have PMIs, which are leading economic indicators, really softening here. The consumer's good, but the trade wars will bring uncertainty amongst small businesses. And they've been splitting the difference with their Chinese counterparts, but if it gets any worse, they're going to quit splitting the difference, and inflation will start creeping in. Uncertainty will creep in for businesses. So I think we have some violent consolidation in front of us the next couple of months. A lot of volatility. Maybe we don't go that many points in a direction standpoint, but some violent consolidation setting the stage for a December rally.
So I want to take the opposite side of this. This is not about Trump tweeting on trade-related issues. You made the point that stocks are flat for a full year. And when did what really happened this year? You had, interest rates peak around 3.25. They're now closer to 1.5. Second thing is industrial data in the U.S. started to weaken in August of last year. Why? Because that's when the benefits from all of the stimulus and the tax stuff started to go away, and you started to see that come in. So if you took away the Trump tweets on tariffs, my view would be 100% the same.
I don't know. The market has not been the same since the day after the Fed rate cut at 3 o'clock in the afternoon when the tweet hit about the September 1st tariffs.
Right.
Market just purely hasn't been the same since. It left us now with all of these new questions. It was the Fed was cutting rates. The market initially went down. It started to go back up, and then you got the trade tweet, which left the uncertainty that we live with now.
You also got the language from China that they weren't going to back down. And one of the things about China is they're perfectly willing to let their people suffer, much more so than the American administration will do. So a lot of people see the Chinese digging in. They don't see any relief on technology transfers or intellectual property theft, and they think this is going to drag on for a long time. In the meantime, the Treasury yields are coming down. Now, what's deceiving about that is that we still have higher yields than almost everybody else in the world. So it could be part of the reason that bonds are rallying is because they're a bargain on a relative scale to $15 trillion in negative yielding debt around the world.
So we need to join that party? Is that the plan?
No, it's not a good method.
Greenspan says it's just another number.
Where has it worked? It hasn't worked anywhere. None of these economies have taken off. Japan hasn't taken off. Negative interest rates will be completely deleterious to the banks. There's no reason at all to do it here.
I agree. I think this belief that lower and lower rates through zero is a good thing, I think, is just crazy. The Fed has a reason to cut for a very different reason. The long end of the curve is steeply sloped, which means that the market thinks we don't have a long-term economic recessionary problem. The short end of the curve is severely inverted between, let's say, Fed funds and out to 2 or 3 years. What that means is the Fed has basically miscalculated where the short end of the curve should be. If they go and maybe Tom Lee's not going to get his 75, but if you got 25 or 50, more importantly, even if you got a statement from the Fed, we get it. An inverted short end of the curve is not what we want it to be, and we will be, make sure that the conditions are supportive. That alone would totally change things without them needing to take big action.
This week,
that's fair.
Well, yeah, one other thing about that, when you have an inverted yield curve, the financials are going to suffer. What is the Russell 2000 made up of? Mostly financials and energy names. They aren't going to do well with an inverted curve. And if you don't get the Russell 2000 involved, you're not going to get any expansion in this market. They're going to stick with large, listed, blue chip names, and it's going to be tough for this market to really shoot for another leg higher.
all right, so what's the short-term playbook for you?
The short-term playbook is the market is basically 3 buckets. You have a growth bucket, and it's only probably 35 names in the S&P that really are growthy names. You have defensive bond-like stuff, which as long as until the Fed, one of 2 things happen. The Fed either engages this market or the economic data turns around, that stuff is going to continue to do well regardless of whether there's any growth there. And then you have stuff which is cyclical in nature, the stuff that Scott was talking about before. And until one of those 2 things happen, you want to stay clear away from those kind of industrials and materials.
So this is
names.
a Hershey, Procter, yield, Staples.
And I'll tell you, though, the second you get an announcement from the Fed, the second you see some better data, they're going to get hurt. But as long as this thing stays sloppy and the Fed stays disengaged from this, those names are going to continue to do really well.
Short-term playbook is be very careful over the next few months. As we look back at the presidential election cycles, the market should do better starting around December. But don't be surprised if we don't see something very unusual out of the Federal Reserve Board, like quantitative easing, or something unusual out of the Treasury, like issuing long bonds. Look at where the 30-year is. Yeah, we could see 50-year bonds issued or 100-year bonds. They did it in Austria. They did it in Argentina. It could happen here with rates at all-time lows.
Maybe you get something coordinated next week, too, out of Jackson Hole. I mean, that's a wild card as well, where you don't want to get too negative in advance of what could be a market-moving event there. Guys, good to see you.